to a plan ERISA bond. We're also asked by plan sponsors and ERISA attorneys, we like our investment advisor, but his contract says that we're to indemnify him for any losses in the plan. Again, we don't recommend that. The advisor should always carry their own E&O insurance and be responsible for their own errors and omission, failure to provide professional services. It should never be a situation where they clearly make a mistake and you find yourself having to make the plan whole. So again, those are a couple risk management strategies that we tell plan sponsors. Also, we talk a little bit about what are some of the mistakes. One of the ones that we see quite often are what are called promised coverages. So a individual in your company is planning on retiring, and you work up an assessment of what some of their retirement benefits may be, may give them an idea what their 401k plan is, you may talk to them about what their COBRA benefits are or any other extended benefits that you may be offering them. And a mistake is made, and as a result of that mistake, your retiree relies on that. And typically when we see these claims, it's always at the downturn of the economy. It's always, well, your investment strategies were so bad for me that I can't retire. I'm 65 years old, and you should have told me I should have been very much, I should have had a much more conservative platform for my funds and non-aggressive. So we see these claims not when there's an uptick, when everybody's happy and making money, but often when we're a downturn economy that we've seen over the last couple of years. Some of the things that a fiduciary, a first-party fiduciary policy can cover are breach of fiduciary duties, negligent acts, simple mistakes. A claim that our company was involved in a couple of years ago had to do with not adding an employee to a health benefit plan. Person was hired over the summer. It was not intentional. They just forgot to add them on. Later in September, that person had a heart attack. It was determined that because of this individual's pacemaker, it was a pre-existing condition, and no coverage was afforded for that. It could have easily been on the health insurance plan had they put them on within the 30 days that they had a time frame to do. Again, it wasn't intentional. It was clearly a mistake. This particular entity did not have first-party fiduciary insurance in place, so they had nowhere to go but to pay potential claims. As you might understand, this was a very large potential claim, and not even potential, turned into a very large claim due to the fact that this person was in a coma and the costs were significantly high. So those are just some of the things to be to start to think about. So hopefully over the last 20 plus minutes we've been able to talk a little bit about why insurance is important to the plan sponsor. We've talked about the difference between first-party fiduciary and third-party fiduciary. We've talked about an ERISA bond that the plan sponsor is required to have. We've talked about an investment ERISA bond that the advisor is required to have. Let's talk a little bit past the investment advisor, because oftentimes you might work with more than one individual on your benefit plans. You might have an investment advisor that does your 401k. They're required or should be required to have E&O. You may work with someone that helps you with your dental and health insurance. Same thing. You should require them to have an E&O policy, and preferably if you can get a copy of the policy and endorsement so that you can make sure that they're adequately covered. Working with someone that doesn't have insurance is never a good idea. As a prudent business person and as a fiduciary to your plan, you want to take steps to make sure that someone can't point the finger that you should have done something or not done something. So you want to have evidence in your files of due diligence regarding insurance. We talked again a little bit about why it's important. Now, I know this has been kind of a quick presentation. Typically, we might spend a couple of hours really getting into the details of what's required and get into the nitty-gritty of policy language. But really the intent today is to give you an overview We're always available to handle or answer any additional questions. We have additional resources on our website, fiduciaryinsurance.com. There's a 4 or 5 minute video on there that you can watch as well. It's something that you can show, that you can understand a little bit more about the coverages. We're happy at any time to review any investment advisor E&O policies that they have in place. I also mentioned about other advisors. If you have a TPA that's separate from your investment advisor, they should carry E&O insurance. If they have discretionary authority, then as a TPA they're required to have the investment ERISA bond. But generally speaking, any professional that you work with, you want to have the knowledge base that they have E&O insurance. So just to highlight a couple things as we wrap this up, the key points that you want to remember is if you're having an investment advisor that's having fiduciary, has a fiduciary duty to your plan, you want them preferably to have affirmative fiduciary coverage. You certainly don't want an excluded. Silent isn't a great area to be in, because now you're relying on trying to prove that there should have been coverage. Modified may work depending on what your advisor is doing. But when possible, if you can remember to try to make sure they have affirmative fiduciary coverage. I hope that was helpful for you today. And again, we're available at any time. Darwin will be presenting you with my email addresses and websites for further information. Thank you.